Three of the best REITs to buy before rates get cut, and I have been buying all of them. Let's take a look at their historical performance. Let's jump into their dividend safety, looking at some very important financial metrics for each of these companies, and let's put them through to our stock valuation model, getting to our updated intrinsic value and our acceptable buy price given that investor margin of safety. Now, the first company is Realty Income. Now, let's take a look. Year to date, it has been hammered down 14%. And wow, this really got all the way down to $45. There was a lot of bad sentiment around the stock. And since then, if we just take a look at the last month, it is up around 10%. Now, it does offer a current forward yield of 5.63%. Those who were able to get it slightly lower would have locked in a yield of over 6%. But we can also see over the last 10 years, it has been fairly volatile, up around 52% depending on when you purchased it. And we see pre-COVID, this stock was sitting just around that $80 mark. So in terms of this company, let's take a look at their financial metrics and dividend safety. They do get a score of 80, so it is safe. Market cap, well, 39.5 billion. It is a large cap company. And when we take a look at some recessionary metrics, we do in fact see they increased their dividend during the 07-09 recession. Sales, well, they were relatively flat. Remember, above the average growth of companies in the S&P 500, which was negative to a larger degree. And they did outperform the S&P with a negative 43% return versus the S&P's negative 55%. Now, increases, they haven't had their full increase for this year, but we do see their latest full increase at 4%. Now, that is locking it in line with inflation. So whilst you are getting a yield of over 5%, you're also getting increases year on year, at least in line with inflation. Last 5 years, slightly lower, so a bit not the greatest in my opinion, but over the last 20 years, 5%. So I would like to see the next full year come in at 5%. That would be nice to see as a shareholder. Now, they are a dividend aristocrat. They have been paying increasing dividends over the last 25 years or more. And when we focus on that dividend yield theory, well, for those that are new, it essentially states a company is undervalued when the current yield sits above the 5-year average. So this is our first sign for undervaluation for Realty Income, still at these levels. Forward P to AFFO, again, 13.3 versus 18.1. So we see another sign of undervaluation. And we can see currently it is in line with that real estate sector P to AFFO at 13.7. Now, when we take a look at payout, which is quite important, and we will focus for REITs on the adjusted FFO funds from operation, we like to see below 90%. That is our personal preference. And what we can see, while it did start off with 90% in 2013, it has come all the way down to 76% in 2022 and expected to be around that for 2023. So that is nice to see. Gives me a lot of faith in that dividend safety. And for those that don't know, Realty Income is a monthly dividend payer. It does pay out dividends every single month. Now, when we look at the adjusted funds from operation, it is positive to see that consistent increase year on year, 241 in 2013, 392 in 2022, and is expected to be over $4 in 2023, keeping up with those consistent increases we've come to love with Realty Income. Now, in terms of sales growth in the REIT industry, we do target 5 to 10%, which is probably moderate growth in our opinion. Now, what we do see, double digits nearly every single year. 2022, a fantastic year at 60%. Last 12 months, the trailing 12 months are showing 24%, so we should be expecting around that when we receive the 2023 reports, which as always, we will run through on this channel, so do subscribe if you want to be kept up to date. Shares outstanding. Now, one thing to note about REITs in general, they do essentially issue a lot of equity. Now, the reason for this is to fund property acquisitions. Why? Well, they retain little of their internally generated cash flow after paying dividends. But one thing to note with Realty Income, even though I am an investor, I do hold a position. They are one of those REITs that do dilute your position as a shareholder a lot quicker than other REITs that we have analysed on the channel, such as MAA, ESS, EXR, and a few others. Now, in terms of total sales numerically, 780 million top line in 2013, 3.34 billion in 2022. So that is some nice strong growth over the last 10 years. And with their acquisition of the new company, SRC, it does look likely that this will continue very strongly over the next few years and beyond. ROIC, now typically for companies on the channel, we like to see 10% plus. It does mean management are able to effectively allocate their capital, but for REITs we tend to look at 3 to 5%. So it's nice to see that it is consistently around that, although I would like it to come back up to 4% to 5% over the next few years. Now, operating margin, it is positive to see the consistency year on year. It did drop slightly, but we can see the trailing 12 months going back into the 40s. And the net debt to EBITDA is quite important. It does affect that dividend safety score, essentially showing us the number of years it would take the company to pay off all of their debt net of cash on hand. And what we can see, it has come up slightly higher than the 5.5 we like to see. But the good news is that the next 4 months or next 12 months, it is expected to come down to 5, below that 5.5 maximum threshold we like to see. So there is a lot of positives and a lot to love with the famous monthly dividend payer. Now, jumping into the valuation model, and as always, if you enjoy the content values being provided, don't forget to smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, for those that are regular viewers, they know we run through each one of these models in detail, describing them. However, for today's episode, we'll jump straight to the output tab. So we essentially have 3 models that we run through. Now, just to let you know, for those that are new, Graham's valuation isn't applicable for REITs, so it isn't one we consider for Realty Income. So the intrinsic value is the average of these models. It comes to $65.54. Now, current price sitting at just shy of $54, significantly higher than that 52-week low that we did see. Now, as always, we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, it is a buy up to 59 if you believe that. At 15%, it is a buy up to 55. And those looking at 20%, well, it is a buy at around $52.43. Now, personally, this is one that I have accumulated more and more as it did drop to its 52-week low. And even at the current price of $54, it is one that I am still adding, as I do personally believe there to be value. So right now, you are locking in around 15 to 20% margin of safety. Now, what do Wall Street say? Well, they believe over the next 12 months, the price to go even higher to around $61, lower than the intrinsic value, but this is what they target over the 12-month period. As always, though, as we go along the video, do let me know your thoughts on each of these companies, whether you've been buying, how many shares you hold, or if you do believe there is bearish sentiment around them, let me know your thoughts. Now we can move on to the second company, which is VICI Properties. It is another REIT in the specialized REIT industry. A lot of properties in the US, in Vegas, a lot of the famous ones as well. Year to date, though, they are down 4%. It is one that I've consistently talked about on the channel, one I have been buying right there, even at that 52-week low. Currently, it is in the midpoint, and it does offer a yield of around 5.5%. Now, over the last 5 years, it is up around 40%, and it is nice to see it has been continually increasing from that COVID drop price, and it has gone higher than that drop or pre-COVID drop at $27, $28. Now, in terms of what is we like about this company, well, let's jump into their matrix. Dividend safety, 50, borderline safe, market cap, $32 billion. It is a large cap company. Now, when we take a look at some recessionary matrix, this was one that was formed only around 5-6 years ago, so there is no data as we typically analyze on the channel. They did have a nice increase this year, in fact 6.4% in September 2023, and when we did analyze this on our channel, if you want to see a more in-depth video, do check that out. They do have a very nice dividend growth CAGR over the last 5 years, and this is above that 4% minimum I discussed on the channel. Now, in terms of dividend yield theory, well, we can see it still looks to be undervalued with a yield of 5.44 versus 5.03. And we still see the forward P to AFFO below the 5-year average of 14.8. Now, in terms of comparison, again, it is roughly in line with the 6 P to AFFO, similar to Realty Income. And as mentioned, it is right there in the middle of the range. Now, in terms of the free cash flow payout, as always, REITs are more volatile, so we focus on the adjusted funds from operation. For hotel REITs, we aim for around 75%. And it is positive to see that VICI Properties is roughly in line with that, with 2023 expected to be again in line at 75%. Now, in terms of the adjusted funds from operation, it did see some nice growth in 2017 to 18, but after that it has remained fairly consistent, and 2023 we are expected again to see a nice increase. Always good to see consistency in any companies that you do look to invest in. Now, in terms of sales growth from 2017, we did see that big jump there, but over the last few years, still very nice to see that double digits every single year, and the trailing 12 months showing 56%. So when that 2023 annual report comes out, we are expecting some very nice numbers for VICI Properties. Now, in terms of sales numerically, well, it's gone from 200 million to 2.66 billion, and we can see the trailing 12 months, as mentioned, showing some very nice growth as well. Shares outstanding, this is what I'm referring to when we looked at Realty Income. This is typical in the REIT industry, and you will find some REITs do dilute your position as a shareholder quicker than others. Now when we take a look at the ROIC, very nice to see above the 3 to 5% that we typically look for REITs. We do see some years of 7 and 8%, with the trailing 12 months again showing 8%, so this is very strong, gives me personally a lot of faith in management, and some very nice operating margins here as well, very high, always good to see. Remember, the higher the operating margin, in theory the higher the bottom line net income should be, which should translate to nice growth on those dividends. Now net debt to EBITDA 3.5 for hotel REITs, and we can see it does fluctuate quite a bit. 2022 nearly double 2021, but it is expected to cool down and come down in 2023, but still fairly high, so something just to bear in mind and probably something to keep an eye on. Now in terms of the valuation for VICI Properties, and as always, if you enjoy the content, value is being provided, do smash that like button, hit the subscribe bell so you are continually notified of these videos as they drop. And as always, if you do want to grab a copy of the valuation model getting to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So we get an intrinsic value of just under $38 with a current price of around $30. Margin of safety is always 10%. A buy up to $33. If we move that to 20%, we can see roughly a buy just a few cents short. So right now on VICI Properties, even at this price, you are getting around a 20% margin of safety. Now, what do Wall Street say? Well, they believe there to be some nice upside to the current trading price, around 20% at $35.50. So based on our estimates and judgments for VICI Properties, you're getting a 20% margin of safety with 20% upside per Wall Street over the next 12 months. Don't forget to drop your comments below. I'm interested to hear so far whether any of these are companies you're adding to, or if not, it's always good to hear different perspectives on each of these companies. Now we move on to the third REIT, which I've also been buying. It is one I hold, is Stag Industrial. It isn't one we have talked about too much on the channel. It is up around 12% year to date in the industrial REITs sector. It is towards the midpoint of the 52-week range and does offer a yield of 4%. Now, similar to Realty Income, this is a monthly dividend payer, with VICI Properties the only company out of the three that is quarterly. Now, over the last 10 years, you would see this up around 72%. Remember, that doesn't include those monthly dividends, and we can see it did reach an all-time high around $48 at the back end of 2021. So when we analyze the metrics, dividend safety sitting at 60, borderline safe, market cap 6.61 billion, so it is a mid-cap company. And when we analyze their recessionary metrics, well, they didn't pay a dividend in 07-09, and they had around average growth of companies in the 07-09 recession at negative 12%. Now, dividend growth is, in my opinion, one area that they do lack, with just under 1% increase this year, 1% over the last 5 years, and we do see a slightly better 3% over the last 10 years. Now, when we take a look at dividend yield theory, we can see it is slightly lower than the 5-year average of 4.47, so you could argue reasonable / slight overvaluation based on this theory. But do remember, as we always say in our episodes, that we never look at any of these models in isolation, and we do conclude once we see all the information and that model at the end. Forward PTFO, though, it is looking roughly in line, so we have a sign here of reasonable valuation, but we do see it slightly higher, or significantly higher in fact, than the sector PTFO of real estate industry. Now, when we take a look at that payout ratio, the adjusted funds from operations for REITs, below 75% for industrial REITs. The last few years, we do see it roughly around that, with 2023 expected to be again around 70%, but we do see some years where it has gone slightly higher, so it is probably one just to keep in mind. Now, when we look at the adjusted funds from operations per share, 156 to 188, it is expected to go higher, but maybe smaller increases year on year than we have seen for other REITs that we have analysed on the channel. Sales growth, very consistent, double-digit growth every single year, which is always good to see. Trailing 12 months at 9%, we are still waiting for the full year and the full month of December, but we would like to see this as well as another double-digit year for Stag REITs. Now, total sales numerically very strong in my opinion, $134 million to $657 million. So it has had some incredible consistent growth year on year. And again, we see another issue with REITs in general, that dilution of your ownership as a shareholder. But it is something that as a REIT investor you should be aware of. ROIC, now the few years of the beginning it was fairly low, but it has started to creep up to that minimum that I look for at 3%, and the trailing 12 months at 4% is always positive to see, assuming this be's the full 2023 report. Operating margin was fairly low, but it has started to pick up, and it does seem to be going on quite a very strong run of increasing year on year, so I would like to think management are doing a very good job, and I do hope this increase on the operating margin does continue. Now, net debt to EBITDA, 5 or below is the preference for the industrial REIT industry. It has been tampering on that level year on year, 5 in 2022, and it is expected to go lower in 2023 at 4.6. So that is positive, something just to bear in mind. The dividend does look safe, in my opinion, on this information. Now, how does that compare to the valuation model? Well, let's take a look. And just remember, the valuation is just the average, or the intrinsic value is the average of these three models, coming to $38. And don't forget, if you enjoy the content, value is being provided, go ahead, smash the like button, hit the subscribe and bell so these videos are dropping as they are released onto your doorstep. Current price at $35, so we do see there is a very little bit of margin of safety. So if we started with 5%, you would be looking at a buy. At a 10% margin of safety, you would be looking around $1 lower. So you could argue between 5 to 10% in terms of the margin of safety. Do bear in mind it is a monthly dividend payer, and also it is good to also see in terms of what the price was. But personally, for me, this isn't one I would add until we see it a lot lower, around $31. And if we take a very quick look at Stag Industrial, we do see that is right at the 52-week low. So personally, this is one where whilst I would add it when it does come lower, around the 52-week low is one where I would start to add a lot more. In terms of Wall Street, well, they believe the share price to be exactly or roughly in line, in fact, with our intrinsic value. So they do see around 10% upside to the current trading price. So on current price, you are locking in on our estimates a 5 to 10% margin of safety, with around 10% upside on Wall Street over the next 12 months. But you could argue this is a company that is for those investors who are looking to use that yield for their day-to-day expenses. Now, before we wrap up the video, we can go through one more thing, which is looking at how these have performed year-to-date and over the last 5 years. Now, we can see that O and VICI are roughly around the same market cap, although Stag is significantly lower, which a lot of people may prefer to see a lot more upside than the other two. Now, year to date, we do see, in fact, Realty Income the worst performing, and we do see Stag one of the best performing, so it is up around 15.22% year to date. Bear in mind, this includes those dividends reinvested. But interestingly, when we take a look at the 5 years, VICI goes from the worst performing year to date to the best performing, up 113%, Stag Industrial up 67%, and Realty Income up a mediocre 9%. Now, as always, that is the end of the content. If you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. If you want to join us in the Essential Discord, then do click on the Patreon link. We'd love to have you. We're talking about all things buys and sells in the market. And finally, don't forget to hit the like button if you've enjoyed the content, helping spread this out to other investors. Subscribe and hit the bell so these videos drop directly as they are released. And as always, have a great day. Catch you all on the next episode and take care.